Ladies and gentlemen, it has come that time once again in which we will host our monthly strategy meeting. Now, any newcomers to Trader Audio, this is a time where we bring our trading team together. And so you will hear firsthand from event trader, chart trader, trend tracker, scalp trader, and blue chip trader. And we're going to discuss some key themes that we are going to see. Now, this is something that we used to do behind closed doors, but we are now giving you access to hear firsthand what our trading team has to say. And gentlemen, I'm going to welcome you all in, and I'm going to start off with a question that will go out to all of you. I'll ask Brett to chime in first just to keep everything in order. But on the forefront of everyone's mind is we have seen some volatility spike in the markets over the last week or so. Now, when we talked last, we had markets that were just grinding higher, grinding higher. We were kind of scratching our heads. We were expecting some volatility to kick in, but timing it was the problem. Well, that August ended with some fireworks, and we had some volatility kick back into place over the last week or so. So the question for everyone, and I'm sure our listeners want to know, have we seen a shift in the overall tone of the market? Do we have a trend reversal underway, or is this just a little blip as this about 10% correction in the NASDAQ kicked in? So, Brett, would love to get your thoughts on that.
Hey, Jim. Yeah, this is Brett, chart trader. So it turns out that on the day that this correction began is when I put out my most recent chart book, and the title of that was Red Flags Building. So we really started this move at a point where we'd finally started to see some of the important shifts in sentiment data and a couple of really high-profile headline milestones pass that put us in a situation where I think we had the right kind of context for some kind of consolidation, because the trend that we had coming into that point, it has been extraordinary. I mean, it looks like a sharp pullback, but if you really just dial up a monthly chart or a weekly chart and pan back and look at what it's correcting, it's just a tiny little, nudge to the downside where we were a few weeks ago. Mm-hmm. And moving into that point, we finally started to see on the sentiment data front, we finally started to see the large options, buy to open options ratio shift and play catch up with the retail only buy to options ratio, which really showed to me that professional or institutional money that was in the market had stopped hedging. And that was one of the points that I've been looking for to start to say we've got a red flag situation where we can finally see some big offers come in, because really at the end of the day, a lot of times when you have a strong trend, the correction that you get is really about people being out over their skis too much, and that causes an order flow shift. When you start to see a little bit of a pullback, people have to react to it in a different way because they've lost their protection. So, we needed to either buy protection, a lot of puts suddenly, or we needed to start sell and reduce our exposure, reduce our leverage, because I'm sure there was a lot of leverage in play as well. So, and we came into that point, and I really think we kind of built up this sort of sell the news context, because we came into that point about a week after the Powell speech, where he finally did the average inflation shift, which basically means the Fed's not going to tighten, even if we see a sharp rise in inflation, and that's a good news for the market. And it was something that the market had anticipated. So it's really tough to start selling your portfolio ahead of the official news. We get that official news, and then we get the splits for Apple and Tesla. And that was kind of, I think, another focal point, because those were the two parabolic darlings that every momentum trader was in, and we really needed to get past those splits. And really, this correction started just a day or two after the splits. So we got past those big kind of sell the news moments. And we got there finally with no hedging in place on the institutional side, and I think that all added up to this correction we've seen, and that was anticipated in the chart book. And at this point, it's been really structured, really kind of. I put it this morning as it's been sort of textbook. We broke the trend line, we hit the 50-day, and we flushed the floor of the last range for the S&P. And now, we're bouncing right off of that sort of prescribed point. And I would look for a test of the underside of the trend line back at about 3,500. And what I see this being, to answer your original question, because of the mounting point that we got to, because of the parabolic point, I think that this is probably a good candidate. There's two types of corrections. One is a correction in price and one is a correction in time, but they both serve the function to move the market toward the trend line. The first goes down and gets the trend line, the second waits for the trend line to catch up. And I feel like we might be seeing something like a weekly chart kind of trend line test that's going to happen more in time than in price. Maybe volatility within that range, but if you really kind of pan back on a really large time frame, we probably got way ahead of the pace of the kind of spiritual core of this trend. And we need to wait for the trend line to catch up. And I feel like coming through the election may be a process of maybe we make higher highs, but probably not run away from them. Maybe we're forming a lateral range here that's going to have some volatile swings back and forth.
Yeah, and I do have that weekly chart up, and if you look at it in context, I'm looking at the S&P futures here, and when you look at it in context, all we did was we spent about a week and a half above the prior all-time high, which we put in back in February, and right now, essentially, we're trading right back where that February high was. So we had a flush, we had a stop run, we had some panic out, now we might be seeing some panic in. I guess, where are you at in terms of the risk of a FOMO opportunity of maybe running back to our highs? It doesn't sound like you think that that is in the works, but we've seen it just money just flows in and out so fast. Like this sell-off that we saw happened, within a few days, and all of a sudden here we are. We're right back where we were 2 weeks ago.
In fact, what I'm saying is I think that probably it is in the cards.
Oh, okay. Gotcha.
I think we're probably forming a range. So I think, as I said, I think we maybe make a higher high, but we don't run away from it. Okay. So, we're going to tag them both sides maybe a couple times and bring in them because, again, so markets, I put this in my notes a few days ago. The equities market is interesting if you trade a lot of different asset classes. If you're only trading equities, you don't notice this difference. But if you trade across different asset classes, equities are unique for being asymmetric, longs to shorts. Most other markets are not, or if they are, it goes one way and then it's asymmetric the other way. Commodities markets are like that. Everybody's long or everybody's short. With equities, pretty much all the time, you're dealing with like a 9-to-1 ratio longs to shorts. That means that pattern structure is different in the equities market than anything else. For instance, lows are oftentimes a single deep stab because everybody who's loaded on one side just starts to puke their guts out and then starts to chase back in. But tops are different because there's this imbalance. You end up with a choppy, messy process if you're going to put in a top. It's very rarely just a big giant spike high and then we just simply go the other way. As soon as you start to get a little bit of momentum on this bounce, the same people who just got burnt chasing the highs last time and puked it out last week, they're going to be, as I've said a few times over the last few days, it's impossible for them to not pull that trigger and chase because they've been so conditioned over the last several months to feel that opportunity pain when they didn't pull that trigger. And the fact that people just lost money, that's an easy way to get it all back quick. We're starting to get the engine going again. This is obviously heading higher. I have to buy. That strength will be chased. So that makes it easier for us to move back up either to the other side of the trend line, maybe flush out the shorts above 3,500, maybe tap the highs, maybe barely exceed the highs. I don't know. But the underlying motor for getting that type of process done is there simply because this market has conditioned people to chase strength. So if we've got a malposition, if we've got the type of situation in place that's conducive to a larger time frame lateral correction, that's still going to be the case, but we're going to have the edges, we're going to have the tails on the upside because people have been so conditioned by recent history to chase strength.
So one more question for you, Brett, just based on some of this conditioning. When we looked at the put-call ratio throughout this whole process, it barely got above 1. I'm wondering, do you think the new traders or what they dub as the Robin Hood crowd, do you think they know what puts are?
Yeah, I think they're going to start to find out. At some point, all lessons are learned. But, and then we don't really know how to figure SoftBank into this whole situation. I mean, there's $4 billion of calls over the last few months too. But that's probably been depressing the put call ratio overall. But yeah, you're exactly right. It's why I've been throwing out the retail only buy to open put call ratio in our sentiment and flow show as kind of a misleading indicator, because it's been way down there. It's been showing for months that we've had a euphoric market, even though that's not verified by other sentiment indicators. So there's a strange phenomenon going on in the options market, and you have to take it a little bit with a grain of salt.
Mm-hmm.
But yeah, I would assume that there is a process by which we will reform the put call ratio back into something that's more historically normalized during the process of a consolidation. But yeah, I mean, obviously this bull trend has been more about the options market probably than anything else, and certainly on the call side.
All right. So, event trader, I want to bring you in now because you almost gave away your thoughts in our pre-market chit-chat today. So I'm going to give you the floor as to what you think. Now, I'm going to ask you the same question in the same context. Do you agree with Brett that this could be somewhat of a short-lived thing, or is there a reversal underway and we're seeing just the early stages of it?
Well, I would agree with Brett in terms of that. I do think that we're in for some chop coming up, and I'll get into those reasons. But I thought for right now, this current movement, it was pretty clean in that bounce off the 50-day moving average in the S&P, and I thought, that certainly was interesting. Same thing for the NASDAQ too, where is this a technical bounce where people that play that moving average and the Pavlovian just buy on the 50 when you get the first test of it, is that in play, or are we going to get a little bit more of a rollover? And I think that still has to play out, and that's going to lead to some questions for people over the next few weeks that we're hoping to get answered. And there's a few things that are obviously on tap that are widely in the next 2 months that are really going to help define this market and might make it a little tougher for the runaway longs that we've seen being placed over the last couple of months. First one coming up is, of course, next week's Fed. Earlier today, we had the ECB, and with the Fed on September 16th, next Wednesday, what we're going to see is, have we hit max policy response in terms of a lot of this drive that we've seen over the last couple of months has been driven by liquidity being pumped in by central banks around the world, not just the Fed. The ECB today kind of struck a little bit more of a hawkish tone, I thought, which helped to drive the euro higher, which, as we said, plays into the dollar, then a number of other commodity-related areas, as well as stocks, because that plays into buying power and everything. But the fact that the ECB didn't really push forward with the average inflation targeting that we saw from the Fed, is Germany starting to win that battle of the economy's recovering better than was expected, and that could continue to play out. Certainly, we've seen that in China, and a lot of people are using that as a roadmap for a lot of people here. So that's something for us to keep an eye out on when the Fed meets next week. Does the Fed come out with the average inflation targeting, and then after they post that, kind of like what Brett was talking with the Jackson Hole speech, do we get the rollover on the idea that there's no further monetary policy that can really be pumped into this market to drive things higher? That could take some leverage out of the markets, could maybe set up a little bit of a bottoming pattern in these in the treasury rates, which could see a little bit of a pop there, and perhaps maybe take away from some of these dividend yielding stocks. So that's going to be one aspect that we watch. Second one is, of course, next up, Q3 earnings season. Does the linearity of this recovery continue in play? We had that secondary pickup of coronaviruses towards the end of the summer, but it really hasn't seemed to offset us as much as that first one did. And as we get closer to the potential for a vaccine being put into play, does a stronger than expected Q3 earnings season, similar to what we saw in Q2, factor in? And then the third big aspect, of course, remains the U.S. elections. What kind of Congress are we going to be looking at? What kind of policies can we start expecting moving into 2021? And do we see market participants start angling and trading along those lines? So there are three big things that I think kind of keeps the markets in check. Now, I don't think it's enough to really roll us over aggressively, but certainly that run-up that we've had in August, we've seen that erased relatively quickly. Still some further to go there. You know, if we're just looking at the NASDAQ, for instance, I think 10,500, if we break below that 50-day moving average, sets up as a key test, because that's where we were trading somewhat sideways action as we awaited some of these Q2 results during the month of July. So market participants are going to certainly be looking at that. So there's a couple of big questions that are going to be answered in the next few weeks. And until we get that played out, I think it's going to be tough for people to get overly aggressive. And thus, I'm not expecting some sort of rip higher to, say, 13,000 in the NASDAQ or, you know, back up to that 3,700 level or so in the S&P. So I think the first thing that we got to do is going to be on the technical side with a retest of this 50-day moving average, see how people respond to that. And that should line right around when the Fed's meeting. And that's going to provide a little bit of insight in terms of liquidity in the markets, and perhaps we see some of that drained. But again, Q3 earnings season will loom right behind it. And so far, we've gotten some pretty good guidance numbers from people. Curious to see if that continues.
All right, I'm curious to get the group's thoughts on this. We know that the election's coming. We are about 6 or 7 weeks away. Polls are going to come out and probably influence the direction of the market. I'm curious as to what you guys are thinking in terms of maybe handicapping a Trump win versus a Biden win. Is the market thinking the stocks will go up on a Trump win, for instance? Stocks will go down on a Biden win. Are there some sectors that we should be looking at, the possibility of one versus the other? What are your guys' thoughts? I know you have to be handicapping this a little bit, so if anyone would like to interject on that, I would love to hear what your responses are and what you guys are thinking.
Yeah, I'll kick off on that one. This is Scott, Blue Chip Trader. You know, I've done some research on this, and I've talked about it in the past on Trader Audio, and you know, especially on these election years. And there's a couple points that, you know, everyone should just be kind of aware of, because obviously, you know, as you go closer to elections, there's more commercials, there's more polls, there's more rhetoric from both sides, bashing each other, and it just becomes this big ball of uncertainty that develops, and it's constantly increasing. And honestly, I mean, from my perspective, you never really know which source to trust, and which one's pulling the strings and manipulating the public. So it really kind of just pays to you know, pull back in on the reins and just kind of do your own research and formulate, you know, which party you want to be associated with when it comes to everything, instead of being influenced by those opinions. But regardless of that, you know, you take all into what I just said, the market, if you look back on election years and how they behave during the September and October timeframe, there really isn't much going on. And I think we've entered that phase here with what we've seen over the last couple of days of distribution. Like I said, the market hates uncertainty. And think of it from a major portfolio manager's perspective, or an institutional endowment or insurance company. They're not really going to be, you know, taking on these massive amount of you know, opportunities leading into the election with just an uncertainty of you know, the potential regulations and the party's policies that could be making some serious adjustments to certain industries. So it just basically becomes a matter of just sitting on your hands and limiting the downside risk. And I think that is, if you look at how the markets responded over the last 6 months, we've had a very strong rally off the March lows. We got into almost somewhat of a euphoric phase right there into the end of August, and now we're starting to see a little bit more of that, you know, that September, October, hey, let's just start taking some money off the table and sitting tight and relaxing. And I think if you do, like I said, if you do go back on the charts and look at the time frame, 2016, 2011, and all those years of election years, you're going to see that the market really just kind of just goes into this sideways range. We have earnings seasons coming up, that's going to be right in October, leading right into the elections. So just everything gets real hairy, real choppy, and it really just becomes a matter of minimizing your risk. Now, I've also done a little bit more studies and research. Honestly, it doesn't really matter which party wins. The market, like I said, it hates uncertainty. So once they figured out who won, then they can basically assess their risk going forward, do the appropriate asset allocations to the portfolios, and manage their risk accordingly from there. And I think that's the main takeaway from all of this, is it's just kind of sitting there with risk. Now, how do you position yourself for that? I mean, I think recognizing that this is going to be a very choppy environment over the next few weeks is critical. But as for like longer term portfolio changes, if you are a little nervous, obviously I think buying some gold and bonds, maybe some staples or utilities, that's probably more of a defensive measure. There are ETFs out there. There's like a low volatility, high dividend ETF that pays 3.6%. It's LVHD, and there's a whole bunch more out there that you can basically look up, and just a place to park your money while there's so much uncertainty and chop that's, I think, really going to take hold here over the course of the next few weeks. So I would definitely look into that. Now, from what I've read, I don't know from what I've read, it seems like whatever comes about on the election day, I don't know if both sides are going to, which side is going to concede to the other side that there was an accurate or fair election. I'm not sure how that's going to play out. It could turn into a little bit more further uncertainty kicking down the road. But, we're going to basically watch the market and see how it responds accordingly. So that's really it. I mean, I don't know if anybody else has any sort of information that they want to chime in there, and they've want to know a little bit more stats that I've come up with. But
yeah, I can follow you, Scott. One thing, so I'd agree with what you said and disagree with what you said in different ways. And the disagreement is, I think to compare this to previous elections, it isn't necessarily an easy thing to do because of COVID and because of the fact that 66% of Republicans say they're going to vote at the ballot box on November 3rd, and 75% of Democrats say they're going to mail in their votes sometime over the next couple of months, and they won't be counted until after the election. So unquestionably, there will be a November 3rd where Trump declares himself the winner, and then there will be a process of counting all the mail-in votes, and then Biden will declare himself the winner, and either side will say that the other side is wrong. Both sides have decided to mount a messaging process in front of this to delegitimize the other side's likely outcome.
Of course.
So they both said, so if we've never had a nuclear war before, and both sides start saying, well, the other side's going to do it if we don't, then you get nuclear war. So we have already started the process. It seems inevitable that everything that we've accepted about the transition process in the past, both sides are worried that the other side is going to low blow or bite or pull hair, so they're going to have to too. So I think that we have already set in place something where the market is going to be, I think, in other words, the answer to Jim's question to me is either side is bullish as long as the country accepts it. And the likelihood of that seems very low, at least to a certain point. And there's probably going to be lots of lawsuits. There's possibly going to be court intervention on some level. And we won't know maybe until sometime in January which side is going to be declared the winner. And we've already conditioned both sides basically through the echo chambers on each side to reject the outcome if it's not their person. So the market is going to be looking at a very different process, I think, than we've had in maybe any prior election where we never went to the DEFCON 5 of saying, well, the other side's going to delegitimize, so we have to do it too. And it seems like this. It's tough to say. Let's lean on historical precedent. So the uncertainty itself is going to be a bigger version of it than we've had in the past, and it's going to extend past election day.
Right.
And but still, the positive for the market will be getting to some point after that, no matter who's the president. I think just saying, well, there is at least something that we can continue forward with as an accepted reality of having a government.
Right, and I think I agree with pretty much everything you just said. But I think that is just going to continuously. I think we've started that sideways range that we're going to see that typically in the past in the September October timeframes. And yeah, I agree. It's probably going to extend probably beyond November 3rd.
Yeah.
So how do you play with it? I think you should be adding, more of these defensive sort of ETFs, gold bonds, staples, utilities, these special smart ETFs like the low volatility, high dividend ones to your portfolio. If you're concerned, if you think that there is going to be not a lot more upside in this market based upon what we're seeing. And I think that's a wise, prudent thing to kind of consider for your longer-term investments at this stage of the game. Once everything kind of settles down or hopefully gets resolved, when that happens, I don't know. Then you make your necessary adjustments to different assets and whatnot. But taking big bets and still staying heavily allocated with technology at this point, or trying to buy up laggards in energy because nobody seems to own those these days, I think is just kind of a foolish guess to try to play something that's not really fitting a narrative of sorts.
Guys, I was looking up when Inauguration Day is, and that's January 20th of next year. Is it possible that we might not even have a result by then? And has there ever been a time in our history where something like that has happened? I honestly don't know the answer to that question.
Year 2000 was a little bit, but nothing like what we're going to see.
Yeah, I think don't the courts come into play then too?
The courts came in on Florida in 2000 and gave it to Bush. So we didn't know after the election day, and it was I think a couple weeks.
Yeah, I mean, this is event trader chiming in. If you want to really go back, I guess 1860, when Lincoln only got 40% of the vote, is what you'd have to be going back to in terms of uncertainty right around the election time. Not saying that the parallels are going to be direct and we're going into civil war, but certainly a divided country. And again, I thought Brett and Scott did a great job with laying out everything that's going on, and the fact that it's going to be a contentious election. That just again leads to the point that I don't think you could have a runaway in any in the markets until we get that settled. In terms of who wins, I agree with Scott. I think the market's okay with either one. There's going to be plus or minuses with either candidate. I do think that perhaps a Democratic sweep could lead to, in terms of the House, Senate, and presidency, could lead to a little bit of a short-term reduction in the markets, just because I'm not viewing the Democrats as anti-business at all or anything like that, but certainly some of the leverage that's in the markets could be pulled out here, because you'd have capital gains taxes that you'd probably have to address, so that could certainly come into play here. Certainly corporate taxes, Biden's already said that he'd go out and do that, but I don't think any of these policies necessarily destabilize the economy as much as take some of the extra leverage that we have in the market, so you can see some of the froth perhaps taken out in a blue sweep. But it's too early to call. If you're looking at individual areas, I think one that's sticking out that kind of strikes me as trading in the idea that somebody's already won is if you're looking at some of these solar and EV plays compared to energy, would certainly suggest that the money going into both of these plays thinks that Biden has a better chance of winning, and that could be an area of short-term volatility that I'd be keeping an eye out on in the next couple of weeks, just because you could make the argument that some of the investment money going into those sides are a little bit off sides at the moment. But overall, everything else that Brett and Scott were just talking about, I think is right on point.
Yeah, just to put a little bit of a positive spin on the elections, after what happens afterwards. So, according to some various sources that I've researched, there's just some fun facts here. And again, I'm trying to be as bipartisan as possible here, so no hate feedback here. But so there is a statistic that says if the market does well leading up to the 3 months into the election, the incumbent party has like a 90% chance of winning. And that makes sense because they basically saying that it's really the economy that makes the decision for most of the whether the current president has been doing a good job or not, and people obviously they rate the economy pretty high up there as a big factor. So that's just one of the statistics out there. In the election year that the incumbent party wins, on average, the following that following year, so for 2021, the market has returned about 16 to 15%. So where there's a regime change and you see a different party come into play, the market only has averaged about 5% for that following year. So again, it's the concept of knowing the policies that are in play and what to expect, as opposed to the new presidency, changing things around a little bit. And then bigger picture, believe it or not, it really doesn't matter, like I said before, which party is in play, Democratic or Republican. Usually over the 4 years that they are in office, they average somewhere about 14 to 15% on average gains. It doesn't even matter which Congress is if it matches up with the presidential party, except for the one where it does say that if there's a Democratic president and a Republican biased Congress, that tends to underperform slightly compared to all the other scenarios. So and again, there's probably a lot more, strife going on in office and everything else during that time. But the good thing is that, capitalism and the way the markets have developed and everything works, it all does seem to just generate, it's not really a major factor, I guess you could say, but the market just tends to generate returns. On a side note, too, I think when the parties do get into play, I think certain industries are going to be more affected than others, and obviously the coal industry under the Obama administration was pretty much tore down and whatnot for cleaner energy, and like Gavin just mentioned, solar energy seems to be popular these days and stuff like that. So you're definitely seeing these industry groups perform better, but the market, the way things are structured with the major indices, always tracking the growing large cap, market cap, outperforming names, the market makes those necessary allocations and those rebalances in the indices to always reflect the growing and better names, and they tend to underweight the laggard and underperforming ones. So again, that also feeds into that whole narrative of why the market seems to do better regardless of which party wins, because of the general structure of the market and the nature of wanting to always outperform and being those leading stocks.
Now, I know we haven't had a precedent for the current election environment, but from a trading standpoint, I'm wondering if maybe what we saw in 2016, now we only had a small window where it was basically election night, where we had some pretty wild swings. So we had a small window of maybe what we could expect just on a more ongoing basis over the next few weeks or leading into the election itself. I'm curious, is that something we should expect? And if that's the case, should we just maybe buy volatility and wait for this thing to settle?
Sounds good to me. Yeah, you want to go after one of the yeah, why not? How to time that? Timing volatility is a tough thing, because every day that the market doesn't get volatile, you're losing. It's a decaying asset class, so it's a little tricky to,
especially the ETFs.
Yeah, exactly. So
the ETFs are just. I want to make sure that everybody knows this, because there's a lot of people that haven't heard me rant about it before. All you got to do with those ETFs is short them when they spike. Don't sit there and keep buying them on the way down. They're flawed instruments.
Yeah, you could have done that just last week, and you would have been up a lot of money too. So that's just a tough thing to kind of sit with over the next 2 or 3 months, knowing that a lot of these ETFs are decaying vehicles. So I would prefer to go something a little bit more, like I said, those smarter ETFs that seem to have some sort of strategy to deal with that, as opposed to the going long the VIX ETFs.
Well, if we do have a case like that, then that is very advantageous to the shorter term and short term swing traders out there. So you guys will be all over that. I would love to get some insight from Scalp Trader and Trend Tracker. I want to welcome you guys into the discussion as to what your thoughts. Now, you guys hone in on individual names. So what names are you guys eyeballing in this environment?
This is Craig, Trend Tracker. Um, there's a lot of stocks that I still like here. I have I have I go back and forth about the valuation. I've learned to kind of put aside my concerns about valuation. Um, I, I do think we could be due for another washout. But I kind of defer to somebody like Brett when it comes to the more shorter term direction of the broader market because as you mentioned, my strength is in picking stocks. So, I hope we do kind of see some lateral consolidation in the coming months because that will kind of allow me to freely pick, swing and pick stocks, which I've done a decent job at over the last few months. One of my favorite long-term plays here is Lyft, and I've been in this since the IPO, so I have been wrong for a while. But this is a long-term secular growth story that now also has a cyclical tailwind as things kind of normalize. The stock is really, really cheap unless you think it's just a cab company, and I am not in that camp. Another recovery play is Eventbrite. It almost tagged the 200-day this morning, which may be a place to kind of take short-term profits. I do think it's worth owning longer term, but I'm sitting on a nice gain here, so I am leaning towards potentially taking some profits soon. In the biotech space, I finally got paid on that AIMT investment. Nestle sort of bailed us out a little bit last week, and AXSM is one of my favorite biotech stocks here. They have a late stage central nervous system neurological pipeline with a depression drug that should hit the market next year. It looks like they're going to have some more data over the weekend or early next week, and they're presenting Monday, Tuesday, and Thursday of next week. The CEO's firm owns like 20% of the stock, hasn't sold any of it despite this huge run we've seen over the last year. So this one checks almost every box in terms of what I look for in a biotech stock. Obviously, these can be very risky, high risk reward positions, but this is a late stage, fairly de-risked asset, and I continue to like this one a lot. Schrodinger SDGR, I stepped in last week. This is another just long-term kind of play that they sell their physics-based computational software that helps biopharmaceutical companies develop drugs more efficiently. They sell it to 9 of the top 10 biopharmaceutical companies in the world. The valuation isn't extremely attractive, but you got to pay up for some of the best stocks, so I think it's worth accumulating at this level. Elastic is one that may be worth adding under 100.
ESTC, is that the ticker?
Correct.
Or Elastic, ESTC, okay.
Yeah, and I am a little concerned about the froth in a lot of these software stocks, but this one isn't egregiously valued. It's not in the 20, 30 times sales range like some of the other high flyers. So I think under 100, it still can make sense. One of the more important points I wanted to make is how many really high quality IPOs are in the pipeline that we'll see in the coming weeks or months. There's a huge list of them, which I have mentioned in a couple morning notes, Snowflake, Asana, Unity, Sumo Logic, Amwell, JFrog, Airbnb, Palantir Direct Listing, and I think my favorite so far, GoodRx. Unfortunately, all of these are likely to hit the market at nosebleed valuations, like we have seen with most recently BigCommerce and was it Lemonade, which was an insurance disruptor. So we do have to use some discipline here because some of them just come out too hot. And Lyft was a great example of this last year. They beat Uber out of the gate last year, and it's just been down ever since. But the amount of really high quality software companies in the pipeline right now makes me think that we're not going to see a total washout just yet. There's a reason why everyone is piled into these software stocks. It's why I've always liked them, because they're long-term secular growth stocks. Low rates are kind of helping with the valuation as well. So if we do see more of a rotation into recovery, cyclical plays, as the NASDAQ kind of falters, I think that's good for the broader market. It's certainly possible that it could weigh on the tech space, but these remain the best stocks to own for the long term, in my opinion. If you can exercise some discipline with the valuation. So I'm excited about the coming months. I'm sure that it's going to be volatile, but there's going to be a lot of fresh blood in terms of IPOs hitting the market. So it should be a pretty exciting time in terms of the stuff that I look at.
Hey, Craig, it's Scott. I just have a quick question for you. Why are you choosing Lyft over Uber, or do you like both of them? Or because I mean, from a technical perspective, I think Uber is already showing and displaying a much stronger chart pattern on a long-term basis right now, as it breaks out over 35, whereas Lyft seems to be the still pretty big laggard over the last 2 years.
Yeah, and Craig, just one thing to add on too. I'm long in Uber right now. I got in at 32, and the technicals let me in, but I also like the diversity in it. So I'd just be curious as your thoughts Uber versus Lyft as well.
Yeah, is it just valuation or is something else?
So they're both cheap. I like both of them long term. Okay. Now Uber is in a better position right now because it has the food delivery business, which is a nice complementary, almost hedge business when now that things are, well, the way things are in the current economy, food delivery is more important than ever, right? A lot of restaurants still shut down or limited capacity, at least in the urban areas. And so this year, Uber is a lot better. I mean, their food delivery business is surging. They're acquiring what's the I can't remember the name of the other. They're like the. I'm sorry.
Postmates.
Postmates, exactly. So they're like the fourth player in the food delivery space. So now Uber, there's basically a three-way tie in the food delivery space. Well, I guess that's not. There's DoorDash, which is another IPO that's coming. And then there's Grubhub merging with Just Eat Takeaway. I'm actually still short Grubhub. And then there's Uber Postmates. So the food delivery business is on fire right now, but the long-term economics are still highly uncertain. I do like both long-term, but I prefer the pure-play U.S. rideshare company in Lyft. The valuations for both stocks is attractive with a low mid-single-digit sales multiple. So for now, it makes sense that Uber's outperforming because their food delivery business is on fire. Long term, I prefer the focus of just ride sharing in the U.S., not a global business. I do like both of them, though, to answer your question for the long term.
Cool, thanks.
Yep.
All right, Scalp, since you had your little introduction, you chimed in a little bit. I'm going to give you an opportunity to talk about some of the stocks that you like. Now, I will say that you've done a very good job of getting out of some of your positions from earlier, say March, early April. where you got some very massive gains. So you've had some dry powder. However, you've dabbled a little bit. You haven't really used up a lot of that dry powder just yet. So are you saving it, or are you finding some opportunity? Are you second guessing yourself? What's going on in your mind?
Yeah, so I'm really kind of waiting to see what the how things are going to play out with the virus, and as soon as I see that we're starting to move forward, which I'm starting to see that now. I mean, I was actually out this weekend and just seeing the level of traffic at shopping centers and restaurants I haven't seen since March, and seems like people are starting to get more comfortable wearing masks to the restaurants. I mean, the Target parking lot was full, grocery store parking lot was absolutely full. And I just hadn't seen that until literally the past few weeks. Almost seems like people in the Chicago area are returning to normal. They're just wearing masks. I mean, I went to Panda Express the other day and the place was packed. You had to order your food and take it with you, but everyone had masks on. So I think people are starting to get more comfortable with the idea of returning to somewhat normal life as long as everyone wears masks. And I know one of the airlines was saying last week that traffic had been the highest that they've seen since March, and I think was at about 50 to 60% of normal levels, which somewhat surprised me.
Hey,
For
Damon, just to add on to that, airlines too, as an anecdotal, I was talking with somebody from Delta. I guess a number of their employees just got called back and are being told to be ready to go in October. Just to build on that.
Okay, that's interesting. So one of the areas that I'm really looking at, and I have positions on in the portfolio, and looking to build more are REITs. I like Redwood Trust, which I've mentioned several times, RWT, which does jumbo mortgages, and they do some other type of lending. But I mean, if you look at Rocket Mortgage, which has just gone nuts and is trading at a ridiculous valuation, one of the things they've benefited from is basically the Fannie and Freddie and the government stepping in to support qualified mortgages, or your normal mortgage, whatever that's called. But the jumbo mortgage market has not been supported. So basically all the big banks pulled out of that market. So anyone transacting like refi, obviously there's a really strong refi pipeline in the jumbo mortgage market right now that hasn't really been touched because no one's willing to do the refis. But the spreads are enormous here. So a company like Redwood Trust, which is one of the major players in this space, as they start to crank up their underwriting, their mortgage refi business again, they're just going to generate enormous profits. So that is still trading below book value, probably about a 30% discount to book value, and they still have some stuff on the books that they wrote down that a lot of the mortgage REITs actually had to sell things at a loss during the RWT is the ticker, had to sell things at a loss during the market downturn. However, Redwood Trust didn't sell anything. So as the market recovers for some of their portfolio holdings, they're going to be able to write up book value as they did this recent quarter. And in the past, this has traded, I think, about 1.2 to 1.4 times book value. I think right now it's probably about 0.7 times book value. So, so that's a name that I like. Trend Tracker was talking a little bit about IPOs and just kind of the rich levels they've been coming to market. I mean, I think that leads me back to the SPAC market. I mean, obviously, we've been doing a lot of trades in that space. There's a lot of volatility, a lot of opportunity, and it's a free look again. Basically, you get to buy this thing at. Well, I also want to add, and I pointed this out 2-3 weeks ago. You're starting to see the SPAC market function more as a venture capital market. So some of the deals that are being bought are pre-revenue, and they might be 3, 4, 5 years out from revenue. And so essentially, one of the things you're doing is, typically with an IPO, they'll some of these deals that have gone nuts. I mean, they've already been, growing tremendously, and they're basically taking the deal to the market at almost like the kind of the peak time to kind of maximize their profits in terms of taking this deal to the market and selling it as an IPO. Whereas with these SPACs, most of these deals are, or a lot of them are pre-revenue or very early in the growth phase. So obviously it's a lot riskier to own these types of deals, but I think the upside potential is potentially massive. And I have a name that actually I'm going to write about later today that I really like. It's a software deal, payments deal that I think is interesting. Still trading right around the $10 or so SPAC offering price. And so again, with these types of deals, you basically buy the stock. They go out and find an acquisition. If you don't like the acquisition, they give you your money back. And so, I mean, it's essentially, it's a free look. It really kind of doesn't get any better than that. And, if you want to, obviously, you need to understand what these deals are, because once the transaction takes place and the companies merge, if the business isn't performing well, then that stock is going to break that 10. Most of these SPACs trade at $10. So it can break 10 and trade down to 3 or 2 or 1 over a period of time. But once the deal is announced, you typically have about, I think, a 2 or 3 month window to basically redeem the shares and get your money back. And, you haven't really there's been a lot of SPAC deals come to market. You haven't really seen anything break the $10 offering price. I mean, if anything, I've been invested in a lot of these different names, and a lot of times I'll buy the warrants just because typically you can buy the warrants for 50 cents to $1.50, and the warrants typically give you the ability to buy stock at $11.50. So if a deal comes to market at 10, they announce a merger, stock trades to 15, the warrants might trade up several hundred%. I mean, I've been in ones where the warrant or the stock traded to over $20, and so you're making 6, 7, 800% on your money there. So it's a way to basically participate without tying up a lot of capital.
Hey, Damon, this is Event Trader. I got 2 questions for you on the specs. How easily have you been able to purchase the warrant site, I guess? And the other is, I was just curious if you checked out the Hindenburg research on Nikola today, and if so, what your thoughts were on it.
Yeah, it's funny. I was chatting with Chart Trader yesterday about Nikola. I was telling him I think that one's going down. I mean, I don't know. I just don't feel they really have anything to offer. GM's basically building the car, so I don't know what value Nikola offers other than as a marketing vehicle. And there are just tons of other companies coming to market right now with EVs. So you really have to have something that makes you stand out. And, basically the idea of you're buying a GM EV, I mean, why not just buy it from GM once they start pushing these things out? And they've already announced they're doing like a Hummer EV, which I would imagine whatever Nikola's SUV, whatever that, it's probably going to be based on the platform for the Hummer that GM's going to be rolling out in the next year or so. And what was your question about how the ability to buy these deals?
For the warrants, have you been finding them pretty easy to get your hands on the warrants, or have you been finding them difficult to purchase?
Yeah, no problem. I mean, sometimes they trade with a little bit of a spread, so you definitely want to use limit orders. And depending on the SPAC, I mean, sometimes they'll start to trade to a premium. Like I bought them for as cheap as 50 cents. And I think the most I've ever paid for one is probably $1.60. Ideally, I like to buy them under $1. So that's just one thing to consider, because if there isn't a warm reception to the deal, then the stock isn't going to really move that much. And so the warrants will deflate. But most of the deals that I participated in, I've kind of gone through and analyzed all these various companies, and like for the one that I'm looking at now, and there's another one actually. I'll mention this one as well. It's a Chinese name that's looking at looking at fine tech, and I think it might be the only Chinese SPAC out there. So I think that could be interesting. And when they eventually announce a deal, that one could rip. But this one is more of a payments focused SPAC with a founder, a CEO, and chairman who've done some really strong deals in the past, have a history of growing businesses and then selling them for nice profits. So I think that's the type of structure that people will get excited about, and the type of backing. So with the warrants, I would just make sure, use limit orders, and simply try to pay as close to $1 as possible. And sometimes you might have to wait. And for some of these deals, I mean, they basically usually have a 2-year window to execute a transaction. So if you get, say, volatility going into the election, maybe you'll see some of these names that have traded up to 10.50 or 11, maybe trade down to 9.50 area or $10 area, or see the warrants that are currently trading at $1.50 trade down to 70 or 80 cents. So it's really important to kind of keep an eye on things so that you can take advantage of the opportunity, because I think there's a lot of people trying to put on this trade these days. And if they start to see it go against them, even for a short period of time, they could get flushed out, and thus creating opportunity for savvy speculators like ourselves.
Hey Damon, just to not throw caution into the wind with these SPAC plays, the special acquisition companies. I have to throw out my theory on these ETFs when they come out, when there's a hot sector that's just absolutely on fire and everyone's trading them. The SPAC ETF, I believe, is already in filing with the SEC for the last 2 or 3 weeks. Its ticker is going to be SPAK. K as in king. And just I have a general theory, and I've seen this repeatedly with the marijuana space and Bitcoin and various different themes over the year that get really, really hot when they feel the need to initiate and push forward an ETF to match those hot groups and hot sectors. That's usually indicative that you're in the last innings of that momentum sort of phase going on there. So by all means, I think I've made money on trading some of these SPACs the last couple of weeks. I continue, to seek them out, and I like them a lot for opportunities. But just be aware that this ETF will be making its debut probably sometime here in Q4, and I'm gonna pull back in on the reins when I start seeing that, and be highly skeptical about their future prospects of running longer term.
Yeah, I understand that. And really with these, essentially you have to think about them as an IPO, right? So it's just deal by deal. And but these are better than IPOs because you get a free look. With IPOs, you kind of know in advance which ones you want to buy, and maybe they price at 25, and you're like, oh man, I definitely want this one. I love this stock. I think it's going to go higher, and then it opens at 70 and goes to 90, right? That you missed your opportunity, right? Or you're chasing it at 200% above where the deal price. So with the SPACs, you can go in there and buy pretty much all of them that haven't done a deal at the same price as the IPO. They typically don't trade significantly above the IPO price unless it's kind of like a celebrity deal, or the CEO has a history of just doing fantastic deals. So it's a little bit unique, very, very different than kind of your traditional, situation where you see, oh, wow, everyone's bringing a deal tomorrow. So for example, the fact that there's so many EV deals coming to market, to me, that's a bubble. That is a huge bubble. And so whether that takes place in the traditional IPO market or the SPAC market, I'm not looking to buy any EV deals. I just think that market is just a ridiculous bubble. You can short names like Nikola and some of these other names, and you might be able to make
Tesla.
75% plus on your money. Of course, like that's, I personally, I rather look for the things that can go up 100% to 500% rather than, spending my time trying to short something like Nikola and having to manage it for a year or 2 years or 3 years as it kind of unwinds, and you have short squeezes and press releases. And you can already see with this CEO, he's sent out tweets. He said he's got a response coming from for the Hindenburg report. I mean, he's not going to go down without a fight. So, so typically these types of situations, you get a lot of press releases that might juice the stock and create short squeezes. So personally, I'd rather find opportunities where I can make upside without having to worry about, getting squeezed or not being able to sleep at night because the stock could get cut in half.
Cool. Thank you.
Yeah.
Hey,
also wanted to add just so with the REITs, so a company like Ladder, LADR, which we have in the portfolio, they basically make loans to developers, and that's a tough market. But one of the things that Ladder does well is they underwrite pretty conservatively. I think their average loan to value is about 65%. So basically, a property in this environment would have to lose about a third of its value before Ladder starts to feel any pain. And I mean, that definitely could be the case in some hotels. They don't have a lot of hotel exposure right now. I think their hotel exposure is maybe less than 20%. But the thing that they do well is they will take over an operation, right, and run it until it gets back on its feet and then sell it. So some of these situations where their borrowers are in distress, like, is really kind of an opportunity for them because they can basically get assets on the cheap. And the other positive for a company like this is that any new loans that they make, the spreads are just going to be enormous, right? They're just going to be able to lend at a higher spread to their borrowing costs simply because of the idea of higher risk in the market. And so that bodes well for their ability to pay dividends, which I think their yield is currently about 10%. I mean, I think we bought it significantly lower originally, and that we're probably up about 100% on it. But the yield, even at the current price, is still about 10, 11%. So I think it remains attractive even at current levels, unless we see a major uptick in COVID cases again and the economy shuts down.
So I just want to really quickly, this is Brett, chart trader. I want to really quickly circle back around to the SPAC idea. And that was an interesting conversation yesterday on Nikola with Damon. But I think it's interesting point that Damon made stood out to me the most, the idea of a free look at these, looking like an IPO where you get a better deal as long as you're willing to have the patience to stay with it. I wonder if we've just passed out of the great age of SPACs, not really so much because we're going to have an ETF or that there's been too many great examples, but I wonder if there's going to be a market efficiency process where the ones that haven't made deals yet start to discount that process better on the upside and lead to some of the deal is announced and they tank afterwards. But the other point is the comparison with a VC that makes these a little bit, if you have your money invested with a VC, someplace like A16Z or Sequoia or Kleiner Perkins, they make their money by 100 deals, they make their money on 5 of them. And they know that 95 of these companies are going to fail on some level. And they make, 5,000% on whatever on those other 5 deals. And with a SPAC, it seems like it's like a VC with no diversification. And I wonder if that's also going to be something that starts to, in other words, we've had this great period where there's been these big deals sitting around to be made that are explosive afterwards, and the market's done a poor job of pricing in that potential because people didn't understand this instrument or this style of investing. And as they start to get more familiar with it, we're going to see 2 things happen. One, they start to trade at a premium ahead of a deal enough to where it starts to be a situation where you really have to have an amazing deal for it to move higher from there. And the other being, we start to see some failures in some of the deals that have been made.
Yeah, and I think that definitely will occur, and it just creates opportunity. I think that some of the bad deals you'll be able to short, and some of the good deals you'll be able to buy at really cheap prices that'll go up
Right.
2 to 5 to 7 times. And so I think just with, again, kind of going back to that whole VC concept, I mean, basically, if you want to participate in a SPAC and you're looking for diversification, you basically have the option to diversify if you'd like by, spreading your money over into different names. Well, one of the interesting things I saw, and I just like, I like it when markets kind of regulate and correct themselves. And so yesterday I saw a deal where it was, I think the deal was announced back in December, and it was like an aircraft related deal where they actually went back and adjusted the terms to bring down the valuation of the deal and to leave more cash on the balance sheet. So because it's really important, I mean, one of the things you're seeing with these SPACs is that the good sponsors are coming back with multiple deals, right? So some of these sponsors have, SPAC 1, SPAC 2, SPAC 3, SPAC 4, right? And so it's really important for them to price the deals at a level that allowed their investors to make money in order to raise money for the next deal. So I think just like IPOs, right? With, say the underwriters typically price them below the real value because they want everyone who's like participating in the, all the people who are getting the free shares on the day of the deal, they want them to make money, right? That's the reward for being my customer. You're at whatever firm and you send a lot of trades through me. I'm going to give you IPO shares of Lemonade or whatever deal there is. You make 200-300% on your money intraday, you sell it, and we're best friends, right? You keep sending me order flow. To some degree, I think that's what's, starting to happen a little bit in the SPAC world where, companies are trying to price deals conservatively enough to see them go up. Because if they break the $10 level, I mean, that's a kiss of death. You'll never be able to raise another SPAC again.
That's a good point.
All right, gentlemen, I want to give everyone an opportunity to toss out some ideas that maybe we didn't cover. I know we were talking a lot about the EV space, and I believe Event Trader has something on MGA. This is a name you've been hyping up a little bit in our pre-market chit-chat. And have you officially gone in on MGA?
No, I'll be buying it in the next couple of days, though. Just wanted to see if it would come back down to test the 200. I'm going to add in a piece and probably average down in it. But kind of like what Damon was talking about with the GM, Nikola, why aren't you just buying GM and MGA? They recently announced a deal with Fisker, which is under the spec SPAQ, of course. MGA trades at 9.6 times forward PE. It's got a dividend yield of 3.3%. Right now, EV production is only about 17% of its revenues here. So it's got a pretty steady business in the auto parts store or the auto supply area. That has been a very poor business, but we've continued to see commentary from the semiconductor space in particular about a pickup in the auto space, which I find to be pretty interesting and I think could be a nice boost for MGA, particularly at pretty cheap levels. So I really like this play here. And we'll be starting to add in possibly later today just to get the first in and an average down. And I just wanted to throw that on. That is ticker symbol MGA, Magna International. And one quick parting shot too, also next week, we got the Barclays Financial Services Conference. So we're going to be getting early commentary from the banks. The thing I'm going to be looking at the most is without the extension of unemployment insurance, does that start hitting in on some of the loan strength there, and a financial crisis could certainly offset any sort of economic recovery. So I think it's an important topic to watch. I am not predicting that by any stretch, but just wanted to throw that on people's radars too.
All right. Are there any other parting shots that anybody wants to toss out there as we kind of wrap things up for this edition.
Yeah, I can jump in real quick and just say quickly, just because we're looking for some kind of lateral consolidation does not mean a market without opportunities. As Trend Tracker said, it's a stock picker's market in one fashion. And as I said earlier, it's probably going to be a volatile range. There's going to be lots of edges to it. There's going to be people chasing the strength. There's going to be some oversold dips that get a little bit too intense. Volatility spikes up. Put call ratio spikes up as we get news ahead of the election that looks, making things more uncertain. We get some deeper dives. We've got other asset classes. The gold market is still really strong. So there's a ton of opportunity in this range. It's kind of the more exciting version of any kind of consolidation range, which would be my main outlook.
All right. So I can't think of better guys to talk to as far as trying to understand the conditions that we're under, the opportunity that presents itself as we head into, election season. We have earnings season. We're almost wrapping up Q3 here. So we've got a lot of things to look forward to. And as you can tell by the tone of the trading team, they're pretty excited about some of the opportunities. So I encourage everyone to stay tuned and keep an eye on what these guys have to say. I will say this much. You guys have navigated this environment very well. You guys were on the short side. You guys were picking up some stocks on discount, using your shopping list, as I like to call it, to pick up some names that you were looking at. And, we had a lot of great ideas out here today. So I encourage everyone to pay attention what these guys have to say throughout the course of the next several weeks. And I believe we'll be back in October, right around the same time, to do another strategy session. So I want to thank everyone for joining us today. And the good news for you all is that we will have a recording. So if you need to go back and listen in to what these guys talked about, some of the good ideas out there, well, you'll be able to do that in the archive. So as always, thank you, gentlemen, for joining us, and looking forward to seeing what lies ahead of us for the next month.
Thanks, Jim.
Thanks, Jim.
A good one.